Household incomes are growing at the slowest rate for 2 decades, putting more strain on family budgets who are wrestling with rising costs and bigger mortgages. So what are the implications for home prices and the broader economy? Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Welcome to the Property Imperative for the week of the 19th of August 2017, as we look at the latest finance and property news. Last week we saw auction clearance rates accelerate. According to CoreLogic, they rose to 2,011 compared with 1,857 over the previous week. This was the largest number of auctions held since the last week of June in 2017, and 1/3 higher compared with the same week a year ago. Melbourne has held the record for the largest number of sales, but Sydney achieved a higher clearance rate at 72%. So there's not much sign of the property market flagging at the moment. More data came from the RBA, when Assistant Governor Christopher Kent discussed insights from a dataset which covers around 280 pools of securitized assets and has information on 1.6 million individual mortgages with a total value of around 400 billion. Currently, this accounts for about 1/4 of all of the total value of home loans outstanding in Australia. There are a couple of caveats about this dataset. Whilst the information covers a significant share of the market for housing loans, it may not be entirely representative. In particular, the choice of assets in the collateral pool may be influenced by the way credit rating agencies assign ratings and by investor preferences. Also, in practice, it may take quite a while until new loans enter a securitized pool. But that said, the first thing to note is that the rate on owner-occupied loans and investor loans used to be similar, but now investor loan rates are becoming relatively more expensive. In fact, up until recently, actual rates paid on interest-only loans have been lower than those on principal and interest loans. But now, interest-only loans are significantly more expensive for both owner-occupied and investor borrowers. This is reflecting recent bank repricing as they seek to repair margins and also to throttle back interest-only lending in response to regulatory pressure. Monthly repayments are on the rise, and on larger loans, this is a significant impost. Looking at loan-to-value ratios, we'll see that there is a large share of both owner-occupied and investor loans with the current LVRs sitting between 75 and 80%. That is consistent with banks limiting the share of loans with LVRs at origination above 80%. Also, borrowers have an incentive to avoid the costs of lenders' mortgage insurance, which is typically required for loans with LVRs when they were originated at 80% or above. And this is consistent with the findings from the DFA market model and suggests that a common held view that LVRs on average are around 50% is not correct anymore. Bigger loans, lower equity, larger repayments. Finally, they looked at offset accounts, which showed strong growth up till around 2015, relating to the rise in the share of interest-only loans, with the two being offered as a package. Interestingly, we saw a significant slowing in growth in offset balances around the same time as the growth in interest-only loans started to decline. Offset balances provide some security for borrowers in times of financial stress. But the RBA highlights that for investor loans, even after accounting for offset balances, there is still a noticeable share of loans with current LVRs of between 75 and 80%. And for both investor and owner-occupied loans, adjusting for offset balances leads only to a small change in the share of loans with current LVRs greater than 80%. This suggests that borrowers with high LVRs have limited repayment buffers. Oh, and note, there was no analysis at all on the most critical metric, loan-to-income ratios, which, as we've been highlighting, is a more reliable risk assessment tool, but one which in Australia we appear loath to discuss. This becomes important when we consider that home prices continue to rise in most states. Separate analysis from CoreLogic showed that the cost of housing has continued to rise across most parts of the country over the past 12 months, pushing the proportion of homes selling for at least $1 million to a new record high. Bracket creep should come as no surprise in markets like Sydney and Melbourne, where dwelling values have increased by 77% and 61% respectively over the past 5 years. While the rise in housing values has been most pronounced in Sydney and Melbourne, most other capital cities and regional areas have also seen a proportional lift in home sales over the $1 million mark. The banks continue to lend strongly in the mortgage sector, with system growth still sitting at around 6% over the past year. ANZ, who reported their third quarter results this week, revealed that they had grown their owner-occupied lending at 1.3 times systems growth, whilst investor loans grew at 0.8%. So lenders are still banking on mortgage credit growth. The RBA minutes were more muted this month, perhaps because of the reaction to the 2% rate lift to neutral last month, which was hurriedly walked back subsequently. They mentioned concerns about high household debt again, and that inflation is running below 2%. They also mentioned that the Australian Bureau of Statistics intends to update the weights in the CPI in the December quarter 2017 to reflect changes in consumer spending behaviour over recent years. They say this is expected to lead to lower reported CPI inflation because the weights of items whose prices have fallen were likely to be higher, whereas the weights of items whose prices have risen are likely to be lower. Underlying inflation was expected to be close to 2% in the second half of 2017 and to edge higher over the subsequent 2 years. Retail energy prices were expected to increase sharply in the September quarter. They said ongoing low wage growth and the high level of debt on household balance sheets raised the possibility that consumption growth could be lower than forecast. The income data from the ABS confirmed low wage growth, with seasonally adjusted private sector wages up just 1.8% over the past year, and public sector wages up 2.4% through to June 2017. So wages for those not fortunate enough to work in the public sector continues to be devalued in real terms. Also, whilst more jobs were created in July, the employment rate is still quite high, and underemployment remains a significant factor. One reason why wages growth is unlikely to shift higher. So what are the consequences of home lending sitting at 6%, inflation at 2%, and incomes below this? Well, the short answer is more debt, and mostly mortgage debt. To get a feel for the impact of this, look at our recent focus group results. Around 2/3 of households in the session held a basic assumption that high debt levels were normal. They had often accumulated debts through their education, when they bought a house, or by running debts up on credit cards. Even more interestingly, their concern from a cash flow perspective was about servicing the debts, not repaying them. One quote which struck home was, "Once I'm dead, my debts are cancelled. I just keep borrowing until then." Debt, it seems, has become part of the furniture and will remain a spectre at the feast throughout their lifetime. The banks, at least, will be happy. So it is worth looking at some of the long-term trends as we did on Friday using RBA data. The traditional argument trotted out is that household wealth is greater than ever, this despite low income growth and rising debt. But of course, wealth is significantly linked to home prices, which in turn is linked to debt. So this is a circular argument. You get a different perspective by looking at some additional trends. And if property prices fell, it would all turn very sour. But let's start with the asset side of the ledger. Since 1999, superannuation has grown by 181.2% and at the fastest rate. But it is arguably the least accessible asset class. Residential property values rose 160.2% over the same period and grew significantly faster than equities, which achieved 135.8% growth. It's no wonder why people want to invest in property. The capital returns have been significantly more robust. Deposit savings grew 159.1%, but the savings ratio has been declining recently. Overall household net worth rose 151.2%, so the story about households being more affluent can be supported on this view of the data, but it is myopic. Overall, household debt rose 161.9%, a growth rate which is higher than residential property values at 160.2% and above overall household net worth at 151.2%. But the growth in income, which is a puny 60.5%, is under half the asset growth rates. Okay, interest rates are lower now, but this increase in leverage is phenomenal and explains the debt is normal findings from our focus groups. I accept debt is not equally spread across the population, but there are significant pockets of high borrowing, as can be seen from our mortgage stress analysis. And it's not just amongst battling urban fringe mortgage holders. Finally, it's worth noting that the growth in the number of residential properties rose just 29.8% over the same period, so the average value of individual properties has increased significantly, at least on paper. To me, this highlights we have learned nothing from the GFC. Our appetite for debt, supported by low interest rate monetary policy, significant tax breaks, and salted by population growth, has created a debt monster, which has the capacities to consume many if interest rates were to rise towards more normal levels. Unlike governments, household debt has to be repaid eventually. This data series clearly shows the relationship between more debt and home prices. They feed off each other, and this explains why the banks have enjoyed such strong balance sheet growth. But the impact on households is profound and long-term. Our current attitude to debt will be destructive eventually. If you're interested in this debate, try to watch ABC Four Corners on Monday night, as they will be looking at the housing bubble and mortgage stress and using some of our data in the programme. And that's the Property Imperative to the 19th of August 2017. If you found this useful, do subscribe to get updates and check back for next week's instalment. And thanks for watching.